Hello there. Welcome back to Cost and Management Accounting in 6. In this video, we want to look at question 1 of this question paper, and we are going to first look at 1.1. And 1.1 reads, choose the correct words from those given in brackets, right? Only the word next to the question number, which is 1.1.1 to 1.1.5. And then the first part, which is 1.1.1, reads, marginal income is calculated by sales less. Remember, when you are calculating marginal income, we are going to say our sales, and then we less our, usually it's when you're expressing it in units, you're going to say sale price per unit, and then you subtract variable cost per unit. So you'll see that variable cost is the response that we have there according to the question. So we have a variable cost being the correct answer. Then 1.1.2 extras in a contract dash the original contract price. We know that it increased, so we have got increase as our correct answer. Then 1.1.3 over applied or under applied is when applied manufacturing overheads are greater than applied overheads. And we know that when we have such a scenario, it's be applied. It will be over applied is when manufacturing overheads are greater than applied overheads. So we've got over applied is our answer on 1.1.3. So over applied. Then we go to 1.1.4, a dash budget is drawn up to determine whether or not to buy a fixed asset. So obviously, this is going to be a capital expenditure. So we have a capital budget. Then I will go to the next one, which is now 1.1.5, which reads a work in progress, but not ready for payment, is called uncertified work. So we have uncertified there, and then those are the answers that we are having on the first part of 1.1. Then we go to 1.2, cite the graph below and answer the questions. So you're given a graph there whereby we're having our curve that we are having for AC, and then we've got BD, BE, and obviously this is the break-even analysis graph that we are having from the look of it. Remember, so for 1.2.1, it's what does F represent? Give an explanation for the answer. So we are F here, and we know that we're at F. What is important is for you to identify what is happening at F, which is an intersection of AC and BD. But remember, this is a representation of our fixed costs, and this curve is starting from fixed cost, so it obviously means it's our total cost. And then we have got the one that is a 45-degree line from the point of origin, which is A, there, and then we know that this is our sales revenue curve. So we try to find out what can we say when our sales revenue equal our total cost. So here, if we are having sales equal to total cost. So whenever you have a scenario, it means when you're calculating your profit, you're going to say sales minus total cost, and you're going to get a 0. That's what it means. Because we are having the same, what this means is that we are having the same amount of sales as the that we are having also on our total cost. If it's 100 here, it's going to be 100 here. In such a way that when you say 100 minus 100, you're going to get your 0. So that can only happen at the break-even point. And you know that at break-even point, that's where we are having this the sales curve intersecting the total cost curve. So F represents our equilibrium point. So if we are going to say the break-even point is where we are having F. So you can come here and try to represent it as 1.2.1. So you're saying 1.2.1, and you're saying the point represents break-even point. Then the explanation now, this is where the company has reached the equilibrium point, meaning that it is not making a profit or a loss. So at the break-even point, we know that there is no profit or loss because the profit is 0. So we are saying the company is making neither a profit nor a loss. So we can just give that explanation that this is a point where the company is making neither a profit No, a loss. So this is what we have on the break-even point. So we can try to see on the next question, what do we have? Next question now needs us to identify the caps. We've got line AC. In AC, we are seeing that this is the AC from A here to C. So we are seeing that this is the 45-degree line from point of origin, and it represents the sales line, total sales line. So here we can just indicate it as the total sales line. Then we go to BE. BE, we are seeing it's a constant figure. So we are saying if here we are having 10,000, it means we're having 10,000 at each and every level of output. At A point of origin, we are having output. Remember, our horizontal axis represents the quantity, whereby our vertical axis represents the sales, the revenue or costs. We can just maybe say revenue or costs. The revenue or costs are on the vertical axis. So we are saying at 0, we have got 0 units being produced, but still we are saying we are paying 10,000 here, 10,000 rands here. And if we produce maybe 1,000 here at this point, it means also we are also going to pay the same amount of fixed costs. So this represents the fixed costs. They do not change with the level of output. That is the description of fixed costs. So we have got our BE representing our fixed costs. So here we are saying fixed costs. That's what we have, fixed cost line. Then we go to BD. BD is here. We see that this line is starting at the amount of fixed costs. So obviously it's total cost, because total cost, to get your total cost, you say fixed costs plus variable cost. So here variable cost changes the level of output. We are saying at 0 outputs, you are going to pay also 0 variable cost. So it means here at B, we are having your 10,000. For example, the example that I have given here, you are going to say total cost is equals to 10,000 plus 0 for variable cost, because there are no units being produced, but the fixed cost will be there. So it means that's where it's starting, which is at 0 units being produced. So here BD now represents the total cost line. So you come here, represent it as the total cost line. We'll try to find out about the next question that we have, that is 1.3, and it reads, complete the table below by only writing the account to be debited or account as per transaction given next to the question number 1.3.1 to 1.3.8 in answer. Right up, we are given the first transaction, direct material issued, which are 1.3.1 is the account to debit, then 1.3.2 is the account to credit. So when you have got the material issued, we are going to see that 1.3.1 1.3.1 is the one that is going to be debited there. So it means we are going to debit the production control. That is the 1.3.1. Then 1.3.2 is the account to be credited, is the material control. Then we try to see on the next one. This next double entry involving 1.3.3 to 1.3.4, and it's direct labor allocated. So you're going to see that the account to be debited is production control, and the one to be credited on 1.3.4 is going to be labor control. So we're going to represent it as such. We're going to say 1.3.3. We are saying production control. And then 1.3.4, we're going to have labor control. One 1.3.5 and 1.3.6 is a double entry for material purchased on credit. So you have seen that on 1.3.5 to be debited, we're going to debit material control. And then 1.3.6 to be credited, we are going to credit as control. So we can just present it as such. Here we are saying 1.3.5, we're having a material control. and 1.3.6, we are using our creditors control. Then we can move on to 1.3.7 and try to see now on 1.3.7 what do we have. Right, 1.3.7 and 1.3.8 is double entry for applied overheads factor. So 1.3.7, you're going to see that we are going to debit production control, and 1.3.8 we credit as applied overheads. So we go there again to represent the last part of this video, which is 1.3.7, and we are saying production control. And 1.3.8, we are using applied overheads. So this is what we have, and this marks the end of what we want to cover according to this video. Thank you for listening. Let's meet again in the next video. As for this video, I'm out.